Welcome to the future of investment strategy, where machines and data-driven models are reshaping the landscape of asset management. In the fast-paced financial world of today, managing risk while striving for maximum returns is a universal challenge. However, the key to better performance is no longer solely in human hands. Machines, through machine learning, ML, and artificial intelligence, AI,
trading to make a living. But the market he faced was an unforgiving bear market.
are increasingly taking center stage in optimizing investment portfolios and transforming the way we think about asset management. At the core of any investment strategy lies portfolio management, the delicate balancing act of aligning risk and reward through asset allocation and diversification. Regardless of whether you're a young investor with a long-term horizon or nearing retirement, the right mix of stocks, bonds, real estate, and alternative assets is essential for achieving financial goals. No two investors are alike. A younger investor, for example, may heavily favor stocks due to their potential for high returns, while an older, more risk-averse individual might prioritize bonds and cash to ensure stability. Understanding risk tolerance and financial goals is key to effective portfolio management, and this balance becomes crucial when determining the allocation of assets. Asset price prediction models. Before diving into diversification and portfolio management, let's explore the predictive tools transforming finance. Asset price prediction is vital for financial analysis, providing insights that guide market decisions. Accurate predictions enhance profitability and reduce risk, but developing reliable models is challenging. Traditionally, two methods were used: fundamental analysis, which evaluates economic factors and company performance to find an asset's intrinsic value, and technical analysis, which looks at price patterns to predict future behavior. With technological advancements, machine learning models like neural networks and reinforcement learning have emerged, offering improved accuracy by processing large datasets, including news and social media. These models can adapt in real time to dynamic market conditions, although they face challenges like overfitting and the unpredictable nature of financial markets. Combining machine learning with traditional analysis offers a promising path for more accurate predictions. While no model is perfect, continuous refinement and understanding of economic principles will drive success in asset price prediction. Now, let's return to portfolio management and diversification. Diversification, the foundation of portfolio management. Diversification remains a fundamental principle in asset management. By spreading investments across various asset classes and regions, diversification helps mitigate significant losses. Think of it as building financial resilience. When the stock market experiences a downturn, investments in bonds, real estate, or international markets can act as buffers, reducing overall portfolio volatility. However, optimizing this diversification to achieve maximum returns for a given level of risk requires more than just intuition. Advanced techniques like portfolio optimization, specifically the Markowitz mean variance optimization, have long been used to strike a balance between risk and return. This mathematical method helps identify the portfolio with the highest expected return for a specific level of risk. Machine learning, revolutionizing portfolio optimization. Today, machine learning algorithms are taking portfolio optimization to new heights. By analyzing vast amounts of financial data, machine learning models can identify trends, forecast market movements, and simulate investment scenarios in ways that were previously unimaginable. These models can detect patterns in the market that are invisible to human analysts, giving investors a significant advantage. Some of the most widely used machine learning models include regression trees, neural networks, and reinforcement learning. Regression trees help identify relationships between variables, while neural networks can mimic human brain functions to analyze data and make predictions. Reinforcement learning, in particular, is a standout model. It improves over time by trial and error, optimizing real-time decisions about buying and selling assets based on market conditions. However, machine learning isn't without its challenges. One key issue is overfitting, where models become too finely tuned to past data, making them less effective in predicting future events.
I've been upping the dose for over a week. It seemed to cut my learning curve.
Furthermore, machine learning models may struggle with real-world unpredictability, such as sudden political events or economic shocks that disrupt market trends. Despite these obstacles, machine learning remains an integral part of modern investment strategies, especially for hedge funds. Hedge funds and predictive analytics.
What do hedge funds think of technical analysis?
Some of them love it and some of them hate it.
Technical analysis. Some absolutely live by it, thinking trend lines, head and shoulders, support and resistances are basically the Bible of the stock market.
Hedge funds have been quick to adopt machine learning and predictive analytics. These tools help identify profitable trading opportunities, manage risk, and even assess market sentiment.
Not for the big fat defense contract he bribed his way into. That's still on. Should be announced next week.
Sentiment analysis, for instance, scans news outlets and social media for clues about investor mood, which can influence market movements. Machine learning also extends beyond hedge funds to individual investors, thanks to the rise of robo-advisors. These automated platforms use algorithms to build, optimize, and rebalance portfolios based on individual financial goals and risk tolerance. Offering lower costs than traditional financial advisors, robo-advisors democratize access to professional-grade investment strategies, making them accessible to a broader audience. Machine learning and asset allocation. The most significant impact of machine learning in finance can be seen in asset allocation, the process of distributing investments across asset classes like stocks, bonds, commodities, and real estate. Traditional methods relied heavily on historical data and linear models, but these approaches often fall short in capturing the complexity of today's interconnected and volatile markets. Machine learning changes the game by learning from new data in real time, adapting to market fluctuations, and even analyzing unstructured data sources like social media trends. This dynamic approach allows investors to adjust their asset allocations more frequently and accurately than ever before. Supervised learning algorithms, such as regression models and support vector machines, analyze historical data to predict future returns, enabling dynamic asset allocation strategies that optimize portfolios in real time. Meanwhile, unsupervised learning techniques like clustering help identify patterns in the market, allowing investors to diversify their portfolios more effectively. Reinforcement learning takes this a step further by simulating investment strategies and refining decisions based on performance outcomes. These models continuously learn from past results, making progressively smarter decisions. Challenges of machine learning in asset management. Despite its numerous advantages, machine learning comes with its share of challenges. The quality of the data used is crucial. Poor data can lead to inaccurate predictions, resulting in costly mistakes. Additionally, some machine learning models are complex and difficult to interpret, which raises transparency concerns. Investors and asset managers may not always understand how certain decisions are made by these models, creating a black box effect that can hinder trust. That said, the potential of machine learning to revolutionize asset allocation and portfolio management remains immense. As the technology continues to evolve, financial professionals will need to balance the sophistication of machine learning models with the need for transparency and human oversight. The role of AI in risk management. In addition to optimizing asset allocation, AI plays a pivotal role in risk management. By analyzing data from a multitude of sources, AI models can detect anomalies, identify emerging risks, and take proactive steps to mitigate potential losses. In many cases, these models can spot risk factors that human analysts might miss, providing a more comprehensive risk management strategy. AI also helps ensure compliance with regulatory requirements by automating routine tasks like trade execution, reporting, and auditing. This not only enhances efficiency, but also allows asset managers to focus on more strategic tasks like portfolio analysis and client relationships. The future of machine learning and AI in asset management. Looking ahead, the integration of AI and machine learning into asset management will continue to reshape the industry. Predictive analytics, for example, will become even more accurate, helping asset managers make better decisions based on real-time data. As AI models evolve, they will become increasingly adept at analyzing new types of data and adjusting their predictions accordingly. The future of AI in asset management also promises greater personalization. As these technologies become more advanced, they will be able to tailor portfolios to the specific needs and goals of individual investors, creating a seamless blend of machine-driven insights and human oversight. However, the black box nature of some AI models still presents challenges. transparency, and trust will remain critical issues as investors and regulators alike demand more accountability from AI-driven strategies. Asset managers will need to strike a balance between leveraging cutting-edge technologies and maintaining the human judgment and ethical considerations that are essential for sound investment practices. Conclusion: machine learning and AI are transforming asset management, offering unprecedented tools for data analysis, risk management, and portfolio optimization. From hedge funds to personal finance, these technologies are reshaping the financial world, making investment strategies more precise and adaptive. Yet, amid this technological revolution, human insight remains irreplaceable. The future of finance will be shaped not just by machines, but by a collaboration between human expertise and the transformative power of AI.